there's a different way to look at startup investing than Silicon Valley does currently. The advice I usually give to people is like diversifying your financials and your investments. I personally put in 5% of my investment over the year to go to startups.
Welcome, everyone, to the Directed IRA podcast. This is Matt Sorensen. I'm joined with a special guest today, Ahmed Ahmed from WeFunder. He's head of funds there. I'm going to have him introduce himself today, but what we're talking about is investing in venture or startups. This is an asset class your IRA can invest in. You can invest in, of course, with non-IRA dollars. We actually had some clients use their IRAs to invest on deals that are on WeFunder, and there's a couple of different things that they do there. Ahmed will get into it. Ahmed, welcome to the show today. Appreciate you being on. Tell us about WeFunder and kind of your role there.
So WeFunder is Robinhood for startup investing. We are a YC company. We started in the winter 13 batch. And for most of our time and efforts are spent towards the Reg CF side of the business. Unaccredited investors can invest in startups through regulation crowdfunding, which was legalized during the Jobs Act in 2016.
And Reg CF is for someone that's like unaccredited. Basically, anyone could invest through Reg CF offerings. These are not publicly traded companies. These are small startups. How much is a typical investment in Reg CF, though? Because those are usually smaller dollar investments, because that's that crowdfunding concept. Get a lot of investors in at smaller amounts.
The median investment on WeFunder for regulation crowdfunding is $250. The average investment is around $1,000. And I'd say typically a company would raise around $250,000 total from Reg CF on average. We have multiple companies that raised $5 million from Reg CF, which is the legal limit. People add on to that through Reg D. It's for smaller check sizes on Reg CF. And I think the most successful cases on Reg CF are companies that just have a lot of customers and they think it's cool that their customers can be shareholders. Mercury has done that, Substack has done that, Replit has done that, and they just had an overwhelmingly positive response, and it's more like a cult following when you introduce that. I think it's primarily like the best form of marketing you can have.
And now there's another side, though, of what WeFunder does, which is more of a fund, typical fund structure side. Tell me about that if someone's maybe an accredited investor.
So the other part of WeFunder, as you alluded to, is the Reg D side. If you are accredited or a step further, a qualified purchaser, we offer you exclusive deals that would only be offered through Silicon Valley and easy for anyone to invest. It's the same checkout flow as Reg CF. So you just see a deal you like, you put in your bank account information or your Directed IRA, and then you just invest straight through that. So my side of the business is particularly seed and Series A companies. We have Series Ds and beyond. So we offered like Anthropic, OpenAI, SpaceX, XAI, a dozen more companies like that.
Yeah.
But we also offer something called the Orange Funds, which I particularly am really excited about, and I spend a lot of my time at WeFunder on. The goal of it is to almost emulate and track the Y Combinator batches as an index. So for those who don't know, Y Combinator is regarded as the most elite accelerator in the world. Companies who go into Y Combinator have a much higher chance of succeeding than those who don't. I think the percentage chance of a Y Combinator becoming a unicorn, so $1 billion in valuation, is at 5%, which is 5x a normal company. And the power law dictates that if you just invest in Y Combinator companies, you will make a higher return than if you invest in other companies. So the recent markups, I guess, that are in the news, we just got a markup for 8 Sleep. I believe we're at 40x. We invested in their YC round at 20 million valuation. I believe they just raised at an 850 million valuation, but it was a nice little markup for us. And then most recent companies that have gone through the batches or that are doing quite well, Corgi is a AI insurance company. We invested in them in, I believe, summer of 24 or 23. They just raised their Series A. Artisan, if you're an SF native, you would have seen their billboards everywhere. They're the AI like sales company.
Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement.
And we're seeing a lot more companies coming from YC raise their Series A much faster than normal.
So that's the orange funds, though. So it's like if I invest in, then that has allocation to some of these companies coming out of YC, Y Combinator.
Yeah. So the aim for the orange funds is YC will typically get 200 companies in every YC batch. It ranges between like 170 and 200. We try to pick the top 25 to 30 companies in each batch, and we just go out and get allocations across the board. We usually do that through, like, I will split the work with 2 other YC alumni or 3 other YC alumni with domain expertise in that thing. We're running the S25 batch, which a couple of your users have invested in. One person is focused on dev tools, for example. They've ran successful companies in dev tools, so they know I trust them more than anyone to decide what's a good investment on that. The other person is focused solely on AI research, large language models, contexts, MCPs, those things that like I never understood until like 3 months ago. Their entire life's work is based on that, so I trust them to decide. And then I have a biotech research. So I was a cancer researcher for 5 years of my life, and I've been taking calls with anything that is remotely close to automating biological research. And there are a couple of good ones this batch, which I was really excited about. We try to determine which ones are most poised to win, and we just spread the board.
So these ones, let's talk about then kind of like that seed, Series A type stuff. I mean, these are really early stage investing. Is that what these are going to be? In like, let's see, these orange funds, for example, they may have a product already, but they probably don't have sales. Do they have sales and revenue yet? Like, where are we talking here? And help people understand maybe kind of what seed and Series A is, how early that is.
So I think primarily, if you're not investing in a YC batch, you could think of seed as they have an MVP. So minimally viable product. They like have hacked something together that is useful for companies, but is not really like at the standard for an enterprise customer. And that's primarily where a lot of the YC companies start the batch out. If you apply to YC, the only chance you have to get in is if you're not ex OpenAI, ex Stanford. You have to have an MVP to get in. And that's where you start. You then have 3 months of the most intensive boot camp you can have for a startup. You have Sam Altman coming in to give you talks. You have the Airbnb founder, Brian Chesky, coming in to give you talks. Paul Graham, who's regarded as the most elite startup investor in the Valley. He like advises companies. And in 3 months, you are basically expected to showcase your product in something called Demo Day, which is used to be for investors to go in and decide which companies to invest in. Currently, companies oversubscribe their rounds before them. But at that point, they're starting to have revenue. They're starting to close these enterprise contracts. And some of them are actually going really heavy, closing really big names. We invested in a company that closed Lovable as a customer. Lovable is the fastest growing startup in history. They were first to get to $100 million in annually recurring revenue. So they're closing really big names. And this is still pre-seed. The orange funds, or the YC funds in particular, I think accelerate faster than anything else.
So Y Combinator, just for people to understand, I mean, this is like, if you're not familiar with it, it is a pretty elite place for if you're a startup, particularly in the tech space, and you have a very compelling big idea where you go get help and mentorship. And it's like, it's very hard to get in. If you get in, it's like kind of like this badge of honor that we got into YC. And so venture and startup investors are like, that's a diligence box checked for us. You know, if the people at YC thought that this was good enough to get in, then there must be some validation to it. Now, most startups fail. And that's the thing we got to understand in this category is the most likely outcome is that if you just invest in one company is it's going to fail, particularly at these early stages. And we can talk about Series D here later and some of this more late stage investing. I just wanted your opinion on this, Ahmed. We had at our event, we have an alt asset summit that we do every year. By the way, it's October 16th and 17th, everyone, altassetsummit.com in Scottsdale, Arizona this year. But we did one in Southern California 2 years ago, and we had a speaker. She was the president of Tech Coast Angels. They do a lot of angel investing. I remember one of her comments was, if you invest in 10 startups, the most likely outcome of nine of them will fail. And maybe one makes it, but your hope is that one that makes it goes 100x and delivers a significant return. I mean, for someone that's new to investing in venture and startup, how should someone think about that? And like, what's their expectation going in? And I know you have the fund model too, we can talk about here, but just as they're thinking about individual company investing, and how should they look at this asset class?
I think there is a different way to look at startup investing than Silicon Valley does currently. There's a certain naivety that comes with being an angel investor in the Valley. I think the advice I usually give to people is like diversifying your financials and your investments. If you're going through your IRA and you're picking X amount goes to government bonds, X amount goes to real estate, X amount goes to ETFs, I personally put in 5% of my investment over the year to go to startups. And I probably could increase it because I have insider knowledge and that is my job. So
invest in what you know.
But I truly believe the amount of capital that goes into these private companies and the timeline for these companies to go public being so much longer than it ever has been before. We recently saw Figma's IPO, Cerebrus's IPO. It has gone through, but it's been delayed so many times. Companies like Databricks is planning to IPO. Anthropic just raised their next Series C. They're going to take some time to IPO. SpaceX is God knows when they IPO. Companies are staying private longer. There is more money than it ever been before in these private markets. I do think people are missing out on money if they just rely on public markets.
So if I'm going to invest in that asset class, though, should I be thinking of a fund model then? Because if I need to diversify, I'm diversifying within all asset classes, I guess, by putting some into real estate, some into stocks, some into bonds, whatever that typical advisor advice would be. But if you're like, all right, well, I'm going to put 5% into venture, let's say, how do I do that? This is what WeFunder is like. You've kind of like have solutions for this and making it easy and like smaller amounts, but also what if 5% for me is 250,000? But I don't want to just buy one company at that amount, So how do I start figuring that out, how to invest in that if I'm interested in that asset category and I want to start doing it? What are my options to do that?
So we have different asset classes, different ways you can invest on WeFunder in Reg D primarily. The orange funds is a good way to diversify, but it's still very narrow. But the orange funds usually return around 30% IRR. So I do think they're like a good class to diversify. The amount of the different companies we get are very random when you look at it in 3 months' time. Yesterday I had a call with a biotech company. The day before I had a call with a drone company that maps how much bale and hay a farmer has collected. I think that's the true nature of diversification. In general, we have different funds. I launched a biotech fund a few months back called Helix, and that was primarily just ways to accelerate research. Anything that goes through FDA testing, just accelerating that process. We are planning to launch an AI fund, a national defense fund, a robotics fund. And those are like different asset classes that people could be interested in. From historical research and context, people that invest in these specific funds tend to have specific domain knowledge in that technology. We get a lot of requests for the biotech fund. That just happens to be the people that are trying to request for it are doctors. They believe that they know what they're looking at and they want something that's closer to home. So they're specifically asked for that. Other people don't want to do the research on AI and it moves so quickly and new companies spawn every other day. Competitors become obsolete. People win and they don't want to have to keep up with that, but they know that is going to be the future. So they're just like someone like me to just grind through it and understand the market. So I'd say if you're trying to diversify and you're a WeFunder investor trying to invest in Reg D, I would look at one of the funds and invest your money in that. However, I would keep an eye out on the individual deals that we get. We usually average around 2 a month. Those are the OpenAIs, the Anthropics, the SpaceX. And if you like said company, and I think those companies are big enough where there's enough data for you to make a decision on, I would save some money for those.
So right now on your guys' platform, I could invest into SpaceX or OpenAI, Anthropic.
We run rolling funds where they're only open for around 2 weeks at a time for that specific company. We closed Anthropic around 2 weeks ago and now it's open for 3 weeks. Before then, we did another XAI round. So what we do is when a round becomes open, we get an allocation. We'll send it out to the people that have invested in the funds before. First, they get early access. And then after that, we open it up a little bit more before we get oversubscribed again. People usually have a timer of 2 weeks to fund their investment. And then that's all the investments we're taking up.
Are those individual investments, are those Reg CF typically, since they're not in a fund model, or are those any of the Reg D, or are those all Reg CF?
They're Reg D. If you want to invest in any company currently on Reg CF, you can go to WeFunder, and then on our Explore page you don't have to be accredited on that. There are, I think, over 180 companies currently open for investment. All
right. So let's say I've determined the amount of money I want to invest. Maybe I even want to use my IRA. Of course, you can do that with your account here at Directed IRA. You can invest in venture and startups. You can use WeFunder. We've had many accounts invest in that. I think we'll see more and more do that as this asset class is becoming more accessible, I think, to individual investors. And I think that's one of the missions that WeFunder has done, is try to bring this asset class to individual investors instead of just the wealthy Silicon Valley or the venture firms. I know there's a lot of people who like to kind of follow other prominent firms and investments. And I've seen this on WeFunder too, to see who else is invested in this. You guys typically will indicate if there's been a well-known venture firm or someone else that's invested in the company. What else are things people should look at? You maybe talk about that or some other things when they're analyzing these different opportunities to see what's a positive or a negative thing I should look at. And I get there's different asset classes and things, invest in what you know in those categories you like, but what should other people maybe be paying attention to?
I think there's two different distinctions there. Reg CF companies are required to file a Form C. You get a lot more information that's legally mandated to be there.
Yeah.
So if you're raising up to 5 million, you have to file an audit. If you're raising up to 1.25 million, you have to file a financial review. So you get access to their financials, which is big for Reg CF companies. For startups, it doesn't really matter that much because realistically, you're not investing.
Of zeros.
Yeah, it's a bunch of zeros. You're not really investing in there like, oh, wow, they made 30 grand of revenue this year.
Right.
What you're investing in is particularly the founder. And I think that's what a lot of people get wrong. They put a lot of emphasis on the company's current traction and the current product state. They don't look at the founder. An analogy I give is Parker Conrad was the Zenefits founder, then turned to Rippling. He was regarded as the best founder some people have met in terms of just sheer ambition and drive. And if you looked at Zenefits at the time that they started, so I believe they were Winter 13, you would have not invested in them if you were basing it off traction and current product state. But if you had no idea what he was building and just had coffee with him for 5 minutes, you would have maybe sunk your life savings in him. It's harder to do when you're looking at stuff on WeFunder because you can't call the founder. But there's enough that you can get in like watching the founder video. If it's a venture funds investment, look up YouTube videos on the founder. We'll show videos on the profile when we're looking at pages and their current traction, obviously, and like the product state. What I mostly look for is, does this person have an inkling of what it takes to be the next Mark Zuckerberg? And that's something that Sam Altman has like repeatedly said he looks for at startups. And I think that's the biggest differentiator.
You're investing in the person as much as you are in their idea, right? Their idea or their product or concept or company. I mean, the person that's going to execute that, you're investing in that as much as anything else. Totally agree with that. All right. So I can maybe see some other, I know you guys will provide some detail. There's been some like marquee venture investors that have invested. Look to who the founder is, or maybe there's some co-founders involved too. Try to get a feel for them. Obviously understand the vision of what they're trying to create. Is there do you see that breaking through? And, you have to use your own judgment on this. This is the fun part of the investing, is able to make those types of decisions and analyze that for yourself. So for us, we're just trying to provide access with your IRA to invest in what you know and what you believe in and to take control of your retirement account funds. And so, and I think places like WeFunder are a great place to go because they're providing this opportunity for everybody. It's not just, you have to get the right connection or you have to uber wealthy. You can even through these Reg CF offerings open to everyone to have some type of allocation, even if it's $250, as we talked about, into ventures or startups. So any other words of advice for people as they get on WeFunder or they're looking at venture startups that you'd want to point people to? I don't know if there's any getting started stuff. It sounds like registering to get information when you are like, oh, I want to get the next XAI allocation or the next, because there's notices, I guess, you're sending out on that to people on the platform.
If you're interested in just joining WeFunder as an investor to invest in Reg CF or Reg D, that's really easy. Just go to wefunder.com and then you can sign up. To get access to the accredited deals, you have to set yourself as an accredited investor as you sign up through the flow, which is simple to do. And then the way we notify people is just through email. It is easy to invest, and that's we're not giving investment advice. The only job I have and I'm striving for is to allow anyone to have the same level of access as a Silicon Valley insider does. If you guys want any information regarding connecting your Directed IRA account to WeFunder, feel free to shoot us an email. We're happy to help.
Ahmed, thanks for coming on. Thanks for everyone tuning in. We'll be back next week with another incredible Directed IRA podcast. Until then, stay calm, self-direct on.